The host of Wall Street Week, David Westin, joining us as he does every day at this time. And David, there was an interesting note circulating on Wall Street earlier today about how the regional banking crisis, the worst, might actually be behind us.
Well, we can hope for that. We'll find out.
Yeah.
But as you know, one of the big issues has been liquidity consistently throughout the entire thing.
Yeah.
And really, do the banks have the money to lend that we would like them to have? And to take us up into that, we welcome now Rodgin Cohen. He is the Sullivan Cromwell Senior Executive Chair. Rodgin, great to have you with us. You really, as I keep saying, are the dean of bank regulation. One of the things that we've been covering here on Bloomberg is the reports of new regulations coming out that will increase the capital requirements for the banks. That's not entirely a new idea, but what are we expecting, and will it affect banks' ability to make loans?
So I think we should expect it. We should see a proposal probably in the next 4 to 6 weeks. And as you point out, it's not unexpected. I think the current vice chairman of the Federal Reserve made it clear that he was not going to confirm his predecessor's view that any changes in capital requirements should be ultimately capital neutral. And it was not going to go down. It was definitely going to go up. So I do think it is a risk for lending if capital requirements go up, because there are only two ways to deal with higher capital requirements. You either raise more capital, which is more expensive, or you reduce the size of your balance sheet. And back to your point about liquidity, you're not going to do that by reducing liquid assets. You're going to reduce loans.
So, Raj, I think you've been pretty busy at Sullivan Cromwell, starting in March, with a fair number of bank failures going on around the country. If they do raise these capital requirements, would it avoid what we saw in March and April?
Actually, I don't think so. I don't know of anybody who would argue, or certainly not convincingly, that the failures of SVB and Signature and First Republic were due to a lack of capital. That may have been true in 2008, but since then, capital at the major financial institutions has increased exponentially. So I just don't see the correlation between March and April and an increase in capital requirements now.
One of the things that we know now that failed these banks was kind of that mismatch when it came to interest rates, basically taking on mortgage loans and other debt that was given out at low interest rates. And then you had the Fed raising rates, and that baseline all of a sudden worked against them here. That was a very slow process. That was a year, almost a year and a half process. And I'm wondering why we didn't necessarily see an adjustment by some of those banks to that new reality.
You know, it's a great question. Why wasn't there an adjustment? And why didn't anybody see it?
Yeah.
So you had the regulators who didn't really see it. You didn't have analysts who didn't see it. And I think maybe everybody had been lulled to sleep. It's been, I don't know, close to 50 years since we have had a interest rate mismatch create such a problem for banks.
Well, let's talk about some of the last times we did have them, because a lot of people, they look at the quick response by the government this time around, and they say maybe we avoided disaster. You go back to the S&L crisis, which was also to a certain extent about interest rate mismatches, and we kind of forget that that was a crisis that took out relatively small banks, at least compared to being systemically important. But it almost was directly responsible for 3 subsequent recessions to a certain extent.
Oh, absolutely.
Yeah.
I mean, there is an historical parallel here. And you go even further back in the late 1970s, there was a thriving, vibrant savings bank industry in New York. And they all disappeared once interest rate caps were removed and interest rates went up.
As Romaine says, some people think we're past this problem now with the regional banks. Do you think we're past it? And another way to put it is, have we found all those mismatches now that we were missing before?
I would hope so. I think that the most serious issues have been resolved. But what you saw was a combination of relentless short selling and social media attacks. And banks are supposed to engage in maturity transformation. It's a question within what guidelines and what boundaries. And if all the depositors at any bank want their money back within 48 hours, the bank will fail.
One of the things we hear about a possible shoe dropping is commercial real estate in the banking sector. Obviously, there are a lot of properties out there that have not been marked to market yet. How big a problem is that for the banking system?
Well, I think it is a problem, but I am very concerned that the problem has been exaggerated. Commercial real estate is a very broad term, and I think only a small slice of commercial real estate is really being effective, and that slice is office buildings in a few metropolitan areas. And even there are vast differences in credit quality. What are the rent rolls? What is the value of the underlying land? How much is the loan against the value of the property? How convertible is the building into different usage? So I don't think there is a commercial real estate problem writ large. There may be specifics with certain types of CRE.
There's been, when we talk about CRE, and we've heard this from investors who've kind of said, look, you have to slice this market apart. For the parts of the market that they do think is in trouble, there's been this concern that those properties aren't necessarily transferable into something else, right? You can't just sort of take an office and make it an apartment building, et cetera, here. Do you think we'll see some significant attrition just in the availability of space that's out there?
There will certainly be some. When you look at a combination of both work from home and, importantly, white-collar layoffs and job reductions, there will be some. But the important part is when you slice and dice it, we're now talking about a small percentage of a bank's balance sheet and limited impact on capital.
I'm curious, when you talk about the banks, what's on their balance sheet, but more importantly, I guess, how they're sort of repositioning here, is there a regulatory argument to be made about a significant restructuring of those balance sheets? Or do you think that what we went through or what they're going through right now is just one of those cyclical things and they'll get past it?
I think it is more cyclical than not. I mean, how many times you see interest rates rise in such a steady progression over such a short period of time? And ultimately, this should readjust. If the Fed is successful, and I am hopeful they are, in breaking the back of inflation, that really solves the problem in very large measure.